Well, we've been in a bit of a down drift. And will some of these supports that we put out hold is the question. 24,600 is on the Nifty, 24,620 or so. The Nifty Bank is starting about 0.25% down, 55,900 and actually 56,000. So kind of around that round number. Small cap index is down 0.25%, 18,023. And I think you've got the mid cap index, which will come up about 100 points lower, 57,450 is where we are at. Advanced decline is negative. 950 stocks are lower and about 670 stocks are higher as things stand. So this is a bit of a lower start. Nifty heat map will give you a sense of how we are starting. Actually, it's a pretty quiet start. Maybe single stocks, broader market in a bit. But BEL is down and Adani Ports is on the other side. So more down than up, certainly 30-odd names down and about 20 names which are starting in the green. Surabhi.
Absolutely. I mean, it's very, very soft. No clear trends. IT is still seeing some pressure. Infosys is down 1%. Wipro is down 1%. There's some more red on TCS, but I think Infosys is bucking the trend. No, actually, Infosys is also down now 1%. So most of IT is seeing some follow-through selling. Eternal is seeing some profit taking after its stupendous run last week. Eternal is down 1% this morning. Shriram Finance also seeing some profit taking. It was yesterday's big winner. The banks are not offering too much support. HDFC Bank and ICICI Bank both are subdued, losing about 0.5% each. Titan on the lower side. So, yeah, it's a little all over the place. On the upside, there's some sense of buying in consumer stocks, some perhaps defensive buying. So, Tata Consumer, Nestle, Lever. These are the stocks that are gaining a little bit. And some metals like JSW Steel are managing, again, 1% up on JSW Steel. Coal India is managing 0.5% as well. But that's about it. Reliance, for the time being, absolutely at the flat line. Very quiet. Hardly any movement on the Nifty.
Well, in this sort of a weakish market, a subdued market, you still have some big winners. Paradeep Phosphates, take a look at that stock. Bucking the trend, that's up 12%. So the market is clearly distinguishing between numbers that they like and numbers that are very subdued. The stock from the mid-cap space is up more than 10% as we speak. Big up move is what we're seeing. Vare Energies as well, one would argue that, the global environment is going to be very, very subdued and maybe, in fact, it has a limited number of years ahead of it in terms of good amount of demand. But some on the street believe, well, no, the runway is still massive. And that stock, in fact, I remember towards I think around 6 months or so ago, it went to around 2,100. From there, that one has given you 50%. And these numbers look good. They're reiterating their guidance out there. Another stock that's reacting positively is Acme Solar. We'll try to get the management, I think, in the next hour or so. Green Energy, that's the other one that's reacting positively. So all these stocks actually are reacting fairly favorably in today's trading session. Premier Energies, let's pull that one up as well. All these stocks, remember, came out with a set of numbers and they are reacting positively. On the flip side, the weak result reactions. You have Aeroflux Industries, that's down 7%, seeing a lot of profit taking out there. Piramal Pharma, that as well is getting slammed. So that's down, in fact, close to around 3%. However, from the frontline index, I think IndusInd Bank, after starting off in the red, has done a complete U-turn. That's moved well into the green. And Marsgaon Dock as well, that was at lower circuit for some time in pre-open on low volumes. That's done a big turnaround as well. Now it's down only 3.5%.
Just one more stock adding Nigel to your list is 5-Star Business Finance. It's down 10.5%. Asset quality is stress and the market doesn't like it. So that's probably the earnings casualty this morning.
Okay. Absolutely flat change on the Nifty, 24,680. And by the way, the market's turned into the green, even as what else is happening? Okay, we'll just put up more specific names in a bit. But while we do that, let's also bring in Rana Gupta, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here on the program. Thanks very much for your time. Let me actually take the conversation in a slightly, you have a global perspective as well, and you, of course, invest here in India. Are you, and I've been sort of reading at the margin about this, that in China, across a range of industries, right, there is a push now to cut supplies, cut output. Basically lessen competition because, there's just there's a glut of supply and there's basically deflation, right? Producer price numbers in China have been negative for a while now. Do you think there are any implications of that in specific industries here in India? Chemicals, for example, comes to mind. Rana. What else? I just wanted your sort of starting thoughts there.
Good morning. No, that's an important aspect, and we should talk about it. There are two aspects to it. One broadly macro. After a long while, we see something macro coming out of China. This drive is called in English anti-involution drive, which basically means to cut supply. And we have seen this something like this 2016. Now, if you think about solar cells, steel, metals, electric vehicle, all this, China has huge overcapacity, and the overcapacity comes from the state-owned enterprises. So we do think some consolidation will take place there. Profits can improve at the margin, and global demand supply scenario at the margin can get better. At the first level, I think this makes overly sold and pretty cheap Chinese equities at the margin attractive. And we have seen some money flow into the China share markets, and I think that has done quite well. On an implication to India, at a flow level, I think this makes China more attractive. But coming to fundamentally, as far as the metal part is concerned, I think that can be benefited positively if the supply cuts really come through. However, I think in the solar and electric vehicle, the overcapacity is pretty massive, and there's not much inflow from China to India. So there, I think the impacts are more global in nature. Lastly, in China e-commerce also, there is a lot of competition, and that's mostly in the private sector. So I think much of supply consolidation may not happen, but there's just a read across. There's been nothing too much read through for Indian equities as such in that aspect.
So metals primarily, Rana?
Yes, that's correct.
And chemicals as well? No.
Chemicals, I think one has to, because chemicals is such a broad area, one has to be very specific. Certain chemicals will do well, but I think the issue is that chemicals, there is a lot of oversupply also. So chemicals really have to go bottom up, part by part, and see which chemicals benefit. Certain chemicals will benefit, but even in Indian chemical space, if you look at the larger companies, they are there are companies who make a lot of it. So at a company level, we are unable to identify that which company will really stand out and benefit. That said, I think at balance, you're right. I think chemical, there are some benefits in certain segments.
Okay, got that point. Rana, hi, morning. So we all know that in India, right now, we're dealing with a bit of an earnings issue. So in this environment where the market's sluggish, earnings are not really picking up quickly enough, just take us through your portfolio construct. Is it more defensive in nature? I mean, what are the changes that you've made over the last couple of weeks, if at all? What are you, where are you parking the cash, and what are you avoiding?
I think a best way to look at this will be, let's say, the last time I was in a channel, I mentioned a pretty positive view on the consumer, on the financials, as well as the infrastructure. So let's see how those are panned out. I think the consumer stocks, particularly in the food tech segment, particularly in some of the select retail stocks, has seen a significant rally. So as in the financial side, particularly the mid-cap banks and the non-banks, which are very levered to rate cuts. Now, these stocks had a good run-up, and the results have not kept up pace. Now, it has to be said, even on a standalone basis, results are a tad disappointing, even adjusting for the quarter one sluggishness that happens. So I think from here on, it's going to be a bit of a patience will be required, because the fundamentals will take some time to turn around. When the asset quality has worsened across the board, I think it will take about 1-2 quarters to stabilize and then come back. Because the stock price had run a bit ahead over last 3-4 months since the time the rate cut and the tax cut happened, I think a period of adjustment, we look at this quarter will be a period of adjustment for consumer as well as the financial stocks. The infrastructure side, we continue to be bullish. I think infrastructure side, particularly real estate and power, will continue to see good demand. I'm referring to top-end real estate and the renewable power plant here. And at the margin, because globally, I think the anxieties regarding trade, anxiety regarding China's oversupply, at the margin is diminishing a bit. That makes some of the global cyclicals that one has avoided, whether it's IT or metals, at the balance or even tactically, tactically a bit attractive than they were beginning of this year.
Hi, Rana. Good to see you in. Tech, I just want to clear that part because of AI, but because of a talent mismatch. Yesterday, to be fair, actually, the stock didn't react very, very negatively. So that wasn't the reason to sell the stock. But do you think with a lot of this negative news that's coming in there, the IT stocks and the IT sector slowly on that process of actually bottoming out, and then it becomes an investable idea? Or do you say there's too much of uncertainty, you'd rather stay away?
Look, I think on IT sector, the AI is going to be a structural headwind. That is not to say that from time to time we will not get tactical investment opportunities. Now, what TCS has done, basically, I think this skill mismatch. I think it has a lot to do with AI, and the way AI is increasing productivity of people. So many people record or not, that's a matter. I think we will continue debating for the next 1 or 2 years, and you will see more on this front. But the broader point is that the IT stocks have the index is down about 15-16% this year, market up about 5%. So they have underperformed 20%. There is bad commentary, and also their clients, they have not closed deals as evident in commentaries of most of the IT companies. But now with trade deals getting signed and US tax cut coming through and all of those things, we do expect a bit of pick up in the deal momentum. All the pricing pressure will remain. I think that is, we have to just accept that fact. And because the valuations have corrected, they look a bit reasonable. There is room for a tactical trade in IT in our view.
Tactical trade in IT. All right. And from the pack, what would you prefer? The ER&D, the large cap names or the mid cap names?
I think because the large cap names and as I said, they remain tactical trades. But I think if someone were to look at somewhat more durable investment ideas, one has to look at companies which are not really mid cap companies, because these companies also by now grown, but where either the management is pretty aggressive in deal wins and going ahead with these deal wins. If you can go through earnings transcript, you will see there are 1 or 2 companies who have got very decent deal wins, even if this macro environment. So I think that is one bucket one should be, relatively speaking, bullish on. The second is the companies where they can do a lot with AI, because I think this AI is one theme which is only going to grow bigger and stronger going forward. There are 1 or 2 companies in Indian IT space where they facilitate AI and agentic implementation with their clients. And I think, and that accounts for a pretty chunky part of the business. I think those are the businesses on a bottom-up basis also we like. But top-down large ITs, I think large cap ITs, they are so big, they will take time to adjust to these realities. And this kind of job cut news that you have heard, I think this is not the end of it. There will be many more adjustments required. But that said, not stock picking is different. There could be room for a tactical trade after prolonged underperformance that IT companies have seen.
Okay. All right. So that's the sense on IT. Rana, what about infrastructure and industrials? I mean, again, here we'll be speaking to one company from that space, KEC International, in just the next couple of minutes. After being among the big leaders of the rally back in end 23, early 24, how are you positioned on these stocks? Because at least from a valuation perspective, some of the multiples have cooled off now.
So the infrastructure industrial side, what we like is somewhat, I would have to say, the rare in that industry, that visibility of cash flows. The construction companies, they hardly generate significant cash. And I'm talking about just operating cash flows. And that need not be like today. But we need to see visibility of cash few years down the line, because in our view, the cash should be reinvested for growth and not too much of data and external funding and liquidation and capital raising, perhaps not the best way in our view. With that construct, we prefer the asset owners, and the asset owners, particularly in the renewable power segment. That is one area that we like. On a broader sense, at least here regionally, we also consider other asset owners as infrastructure plays, and this will be something like a telecom, hospitals. They're also even airports. They're also infrastructure plays. So asset owners, steady cash flows, growing cash flows. Those are the kind of businesses that we like.
All right, interesting. Yep, interesting perspective on what sort of you can consider as infrastructure, and you're looking at some of those other related allied sectors as well. Got that point. Rana, thanks very much for joining in. Good conversation as always. Wish you a good rest of the day. Well, the market has stabilized. For what it's worth, I mean, considering weak global cues this morning, there is a bit of a bounce. We've been saying that we've been at the lower end of the range, oversold levels, whether you're looking at the F&O market cues, etc. So maybe from those levels, at least there's a bounce. Let's see. Bulls will hope this really holds on. Let's focus on KEC International now. The company reported a steady set of numbers for the first quarter. Profit growth was healthy. The order inflow is something that analysts are watching very, very carefully. Of course, KEC has given a guidance of 15% revenue growth this year. Let's talk more about the outlook and what's happening on ground. We have Mr. Vimal Kejriwal, Managing Director and CEO of the company, joining in. Mr. Kejriwal, good morning. Great to have you back on. Always good to hear from you. So, sir, let's start with the order inflow guideline. I mean, otherwise your pipeline is very strong. I think your order book plus L1, you're at 40,000 crores. So that's a solid number. But I think analysts are looking at the granular details of how many orders you'll get this year. I think the intake was about 5,500 crores last year. Is there any concern of a slowdown, particularly in the West Asia markets, because oil prices are weak? Is there any decline or softness in tendering activity there? Is that a risk?
So let me give you the correct figures. Actually, we got 5,500 crores of orders this year, which is almost 28% lower than last year. But we are L1 in almost more than 6,000 crores, and largely in the T&D area. And surprisingly, most of them are in West Asia. So I don't think we are seeing any slowdown. I'll say any slowdown in that part of the world, whether it is Saudi, whether it is Oman, whether it is UAE. They are just continuing to, keep on releasing tenders. In fact, right now we have almost 25,000 crores of tenders to be quoted in Saudi itself. Okay. So I don't think people have to worry about whether West Asia will do well or not. I think we are very positive about it. I think what we need to also understand is most of these orders are on the back of renewables which are being set up. So most of them are for the transmission of power from renewable sector. So I don't see any risk right now from the oil prices in this market.
Okay. All right. That would be very reassuring for all your stakeholders to hear that the West Asia market is still booming and looking good with renewables specifically. You said 6,500 crores. Those are the orders for which you're L1.
Not 6,500, but yeah, I don't know the exact, but it's 6,000 plus. And I think almost 90 to 95% are in the T&D sector. And I think close to 4,500 or so are or maybe more than that, are in the T&D part of it.
In that. Okay. So you're sounding still very, very optimistic, at least on the T&D pipeline. Water will come to later. But just, hearing you out, you're confident of delivering 15% growth this year, top line?
100%. We are very clear.
Okay.
All right.
Kejriwal, 15% is top line growth as you see it. Should not be a problem. Good morning, sir. Just to complete that earlier point, where you said that most of the orders are renewable, and that is something we've heard from other companies as well, right? I mean, because the grid does not exist and it has to be built. If you've got to set up all these renewable projects and you've got to get the power from where it is being produced, generated to where it is needed. Is there a slightly longer kind of runway, some numbers you can share with us, because you're speaking with customers, you know what's happening there, especially in West Asia, Saudi, etc. Is it going to be a very large business over the next a few years?
Yeah, morning, Prashant. I think you're very right. There will be a very long business. I can see very clearly Saudi has just announced some more new tenders for renewables. Abu Dhabi is going. Oman is doing very well. I think all of them are very clear that they want to reduce their dependence on oil for power, and they want to use oil for other purposes, etc. So very clearly we can see in West Asia, India, you are very clearly aware that from 500 gigawatt now the government has upped the target to 600 gigawatt in 2032. So I personally do not see any risk happening on that part of it. The other piece is that all these renewable projects come at a place where you have ample land available, which is generally far away from the consumption center. So they require large transmission lines. So which is where I think we are very positive on those markets.
Can we estimate some sort of a, I know it's an unfair question, but a TAM, a total size of opportunity here, just based off this renewables, etc. being set up?
I don't think I have that number right now, to be very honest with you. But if you look at the T&D orders to be tenders to be bid or which are under bidding and not been decided, is around 90,000 crores as of now. Okay, that's the size, and that's for next 3 months sort of thing. So there's a huge opportunity which we can see in this market.
So it's. I mean, you got to pick and choose the work you want to do. I mean, there is enough demand.
I'll say almost.
All right, hi Mr. Kejriwal, good to see you in. And as you're indicating, in the past quarter as well, we did see TNT projects, higher margin projects got executed, which helped margins perk up a little bit. But you have guided that margins will improve from here on. So the top line growth, we've got 15%. Margins, you continue to hold on to that 8.5% guidance. No risk there?
No risk for that. 8 to 8.5 is what we have been guiding. First quarter, we did 7%. So I think we are on track for that.
All right. So the margin trajectory continues to improve from here on. Give us a sense, even in terms of your debt reduction. You were told us last time around, I think as a percentage of sales, it was around 3%. That's likely to come down. It appears you have repaid some debt. So what is the updated debt number, and will this continue for the remaining of this year in terms of debt reduction? The absolute number is what I'm asking. And working capital days, you were guiding that it comes down to around 110 days by the end of this year. That as well holds on, right?
Yeah, that holds on. Although in Q1, we were slightly off.
Yeah, 120 plus.
128 instead of 122, what was there last year. But I think we are very clear on that target that we should be achieving that. Debt, we have been able to have a reduction of around 250 crores despite an increase in sales. So I think we are looking at that debt going down below 5,000 as an absolute number. And our interest to revenue has been 3%, come down from 3.4%. So we're trying to take it to around 2.5% is what we are looking for.
Mr. Kejriwal, now I'm coming to the water business, and you explained it really well to us last time around that it's an issue with payments being released by states, and then you have to be very careful and take state-by-state calls. So what is happening with that business right now? Also, just give us, so we understand its relevance in terms of, say, your total order book. What percentage is water, or maybe your total revenue pie? What percentage is water right now? And will you be getting, the 1,000 crores plus revenue, which you told us last time? The things are picking up. It's beginning to move. What's happening here?
So let me come to the numbers first. So this quarter, I think we got, for Q1, we got around 257 or odd crores of cash flow from the business. Okay. And even now we have got some money. In fact, yesterday evening also we got some money from one of the states. So we are primarily in two states, MP and Orissa. MP has been relatively much better in terms of payment. Orissa is just opening up there. I think they had some issues, so they were not making payment. But now the payments have started trickling in. I'll not say it started flowing in, but they started trickling in. The way we have been looking at it is that we are not planning to increase our exposure. So whatever cash we get from the business, that is plowed back into that business for completing of the projects. So I think when you look at the number, if I got 250 crores of cash in Q1, and if you multiply it by 4, I assume it will continue, then we should be reaching our 1,000 crores of revenue target for the year in water.
And what is water? What is it as a percentage of your order book? And will you now be, degrowing, as they say, degrowing or defocusing on this business?
I don't think we can defocus. It's a strategic business, and I think the government has to sort out the issues in the cash flow, because part of it gets funded by the central government, part of it gets funded by the state government. So I think there is some place where it's not working out very well. I think it's getting sorted out. As far as the order book is concerned, I think we have roughly around 2,000 crores of orders yet to be executed in my order book. So that's, if you take 40,000, then it's around 5% of my order book.
But it's a higher margin business, like you explained to us.
It's a
double-digit margin business. So hopefully it gets sorted out. Got your point, sir.
Slightly forward-looking kind of this thing. This is war in Russia, Ukraine, right? Now we've heard from some, a lot of the transmission, distribution grids, etc., have been completely destroyed in that country. Is that whenever and President Trump is calling for a ceasefire in the next 10, 12 days. I mean, the war is going on for 3 years now. I mean, do these kind of things open up whenever there will be a big rebuild effort whenever it happens, whenever the fighting stops? Are those also opportunities in your as you see them?
100%. I think these are places where there are a lot of opportunities. And let me give an example. Already we started receiving inquiries from Syria. Okay.
Oh, wow.
Okay, so I'm just saying that, and Iraq is already rebuilding, although I am not there right now, but some of my competitors have already gone to Iraq where they've started rebuilding lines. Syria is probably one step behind that, and Ukraine is probably still a little bit behind that. But in Ukraine, I know we've been getting inquiries for supply of, transformers and towers, etc. Nobody will go right now to build a line there, but supplies and all inquiries are already being discussed. I've received some of the inquiries. So I think maybe 6 months down the line or something, or maybe even earlier, you may start seeing something happening in that market. Okay.
No, that's very interesting. And those things, of course, I mean, very difficult to put a number to it, but those are potentially very large rebuild efforts, right? Typically billions of dollars over, of course, spread over many years. We'll continue to track it, but it's interesting you're saying you're already starting to see inquiries come through, even from Ukraine, etc. Thank you very much, sir. Thank you for joining us. It's always a pleasure having you here on CNBC TV18. Markets are up about 8 points, but 8 points is not the headline. The headline, of course, is the bounce we've seen from the day's low, although we are within the first 1 hour time frame. So still, I mean, I think finding our feet for the day. Nigel.
All right, well, let's get to our next earnings conversation then. TTK Prestige reported actually a weak performance in Q1. Muted revenue growth, decline in margins and profits. To discuss this and the impact of the quarter gone by and how is business shaping up from here on, we are now joined by Mr. Venkatesh, the Managing Director and CEO at TTK Prestige. Hi, sir. Good morning and thanks a lot for joining in. I'll tell you what, for your category and your company as well as the segment on the whole, the street is willing to look ahead. So the past quarter was a weak one, but that was anticipated. Tell us, how are things likely to shape up from here on? And before we get to numbers, are you seeing signs that Q2 is gradually shaping up to be better? There's a recovery in sight. You'll also, towards the end of September, it'll be pre-Diwali, so there could be some festive buying. So are there green shoots that you're seeing?
Good morning. Thanks. I would address this in two parts, one from a company perspective and two from the industry perspective. Our belief is that the industry is slowly back on track. Volume growth is still a little more tepid, but we do see two distinct trends. One, in the urban markets, we're seeing premiumization happening, a lot more of value growth happening in comparison to the volume growth. And two, in the bottom end of the spectrum, as we see some of the lower priced opportunities, there is volume growth happening. So combined, in our view, the industry looks a little tepid at this point of time, but our belief is that it will start picking up as it moves forward, driven by both premiumization and also volume growth at the mid and the bottom end, as we see it. From a company perspective, you're aware we've gone through a large-scale transition of leadership, and currently the management is in place, stable. And we do believe as we move forward, some of our efforts that we are putting in terms of market corrections, in terms of our go-to-market strategies, this would lead us to a reasonably good growth as we move forward.
Okay, all right. You were earlier guiding for high single-digit growth in this year. Do you think that's on? Is there a possibility you can deliver a double-digit growth? And also, if you could give us a sense in terms of margins, what is the band we should work with? Q1, obviously, you didn't get the benefit of operating leverage. But since you're talking about a recovery from here on, that will play out as well.
I don't want to give any guidance, but like I said, I think we're quite confident that we will move into reasonably good growth as we move forward. As far as margins are concerned, we are considerably investing in a little bit of futuristic investments across capability building, across capacity expansions in specific categories like cookware. And we do see, therefore, there would be a substantial investment in both OPEX as well as CAPEX that would go over the next 2 to 3 years. So that would place our margins at a reasonable place. Suffice to say that I think we are in a phase where a little bit of additional investments when compared to the industry is happening, both in terms of capability as well as in terms of CAPEX.
For Mr. Vijayaraghavan, good morning. Any specifics you can share with us in terms of what how are you thinking about the cookware as a segment for FY26? Any key changes in product mix, etc.?
We've actually moved ahead. We've had some product portfolio gaps in the past, which have got sort of corrected today. Currently, as we speak, we do believe that cookware is one of the segments that will continue to grow reasonably ahead of the other categories that we are in. For two reasons, like I mentioned, there is a lot more replacement cycles have got shortened in the cookware segment, a lot more acceleration around volume. That combined with premiumization happening in the top markets, I think cookware is a little more better poised than appliances and cookers in terms of growth. And we would like to capitalize on this as we move forward, and which is one of the reasons I said the capex expansion is happening at this point of time. Having said that, I think currently our NPDs as well as our product portfolio is reasonably ahead of the industry, and a lot more emphasis on the cast iron portfolio, the stainless steel tri-ply portfolio, a lot more emphasis on some of the new materials that we would like to experiment with. Ceramic, for example, is one of the materials that the industry is experimenting with. Globally, it's picking up, and I do believe that in India, that probably would be one material-specific idea that would probably pick up as we move forward.
Mr. Raghavan, so growth you're saying should gradually pick up. What about margins? Because we've seen a fair amount of compression on margins in the first quarter. The company's been guiding, saying that, there will be some readjustments on margins before things finally settle. So where are we in that curve?
So
is this a bottom, or is the bottom still further down?
So I would suggest that we are at the initial stages, like I mentioned. It's a 2-year to 3-year transition. I would say there would be a couple of quarters before we could probably sort of answer this in a very firm manner. I think the guidance from our side is that we stay invested, and the investment is of substantial quantum, like we mentioned. And therefore, I think for a couple of more quarters, we would see this happen where there would be a little bit of EBITDA dilution as we had predicted in the past.
So some sense of it, I mean, I think you're just above 6% now at the EBITDA level. I mean, how much lower could perhaps margins get, and where do you see the point of turnaround? You're saying 3 quarters down the line, by the time we exit FY26?
Yeah, towards this year, we should definitely see a turnaround.
Okay, all right. What about the mix for you between rural and urban? What is your sales mix?
So we are largely urban driven, while we have a distribution system which is fairly entrenched as a leader in the rural markets. Our belief is a lot of our growth today is coming from urban markets. Rural, in my mind, is still unexplored. We did have an indirect channel through the institutions that we used to sort of sell in the rural markets. Now, that channel has been under pressure for the last few quarters, given some structural changes that are happening there, the multi-finance institutional opportunities. So as we speak, I think we are largely urban driven at this point of time, with a large opportunity at the bottom end. Rural, I think, is something that we would believe would start kicking in for us a couple of quarters down the line.
Okay, all right. What about the export markets? Mr. Trump has something to say every day. But, going according to what you have heard, some Indian producers in various segments, they believe actually it's throwing up an opportunity to push through exports. That's still very small for you. But is there an opportunity, in the horizon, say, 4 to 8 quarters down the line, you can actually see a big opportunity emerging?
So I think there are two trends as far as exports are concerned. There is definitely a willingness from most of the global players, including European players. So I see it as two parts. We play largely in the OEM segment, as we call it, or the white label segment. We are not into branded products at this point of time. In the white label segment, if you were to look at, there's a lot of intent to shift to India. Of course, there is an ecosystem issue today in terms of costing that we need to work out when we compare it with, say, competitors like China. But I think there's an intent from a large part of the globe to shift supply chain towards India. And that's a very positive sign that I would say from a long-term perspective for white label exports in our categories as we speak. The second part of it, as far as the US market is concerned, I think the signals have been mixed. Our experience has been that a lot of players, including our partners in our branded space, they have sort of not been able to conclude as to what is the impact, and therefore there's been a little bit of holding back in this quarter. But if I were to take a slightly longer horizon of 2 to 3 quarters, I think it will play out, and it may play out to our benefit.
Okay, all right, Mr. Vijay Raghavan, good conversation, sir. Good luck. Thank you very much for joining us. And we'll keep a track on what's cooking at TTK Prestige as we go along. Thank you. We'll take a break here. We are coming back in just a bit. I mean, the big stock move of the day has been Tata Chemicals, right? I mean, it came out of nowhere, and that's at almost $1,000 now. It's coming through very, very sharply. I think there is an upgrade which has come through as well from Morgan Stanley, and we'll highlight that with our team as we go along.
Just one more stock, Jaiswal Nico. We were, last week we had explained here on CNBC-TV18, there were 25 crore shares with an ARC that was gradually being absorbed. In yesterday's disclosure, a very, very small 52 lakh shares has been bought by the promoter entity of Shyam Metallics. It's an extremely small investment that's come out there. But the bigger point is, from around 25 crores of holding by the ARC, that ARC's holding has now come to sub 5 crore. And currently the volumes are very, very large. So we'll have to keep an eye out on this one. But we've highlighted that this is an overhang. Till the ARC continues to hold stake, that will be an overhang. Once that gets absorbed, Jaiswal Nico, there's a filing on the
Put up the,
exchange.
let's put up the stock if we have it for a quick bit. And then Jaiswal Nico, right?
Yeah, that's the one.
We should have, are we able to pull it up? We should, if, okay. I think it'll come up.
No worries.
Now. On your screen now. So
Yeah.
that's the one that Nigel is talking about. 12.5% higher, 46.5 rupees. So it's a big move which is coming through. We'll take a quick commercial break here. We're going to come back in just a let's talk about the renewable space, right? And we have a bunch of listed companies now which allow you to give which give you a play on renewables directly, solar especially. And I have the management of Premier Energies with us now to talk to us about the numbers which they reported for the quarter. Vinay Rastogi is Chief Business Officer at the company. Vinay, great to have you with us here on the program as always. Good morning. I would like to talk about competition, which I think is the big bugbear, which investors are worried about, which we will get to in just a bit. But let's just address the numbers for a quick bit. So order book in the quarter, as I see right now, is kind of flattish, right? But you look at margins have come off. They were about 33% in the fourth quarter. They're about 30% in the first quarter. But these are still, compared to a year ago, they're still significantly higher. They're almost double. So quarter-on-quarter decline, but year-on-year, I mean, it's a big jump. Order book, though, is kind of flattish. So let's just address those, especially the profitability point, Mr. Rastogi. The decline that we saw on a quarter-on-quarter basis, what was it on account of? And could you guide the market for the full year, EBITDA margins? Mr. Rastogi, you'll have to unmute yourself, sir.
Hi, can you hear me?
Yes, please go on.
Hi. So I'll start with the order book. I think our order book has still grown over the last quarter. What has happened during this quarter is that there was a lot of volatility in the international prices, particularly in relation to some of the raw materials. So as a result of that, both the customers as well as we as a company, we felt that it was a better time. It was a time to kind of let the market settle down a little bit. Then move towards order execution. So as it happens, since the end of the quarter, we've already signed some large orders, and our order book is actually very healthy. So I won't read too much into the quarter ending number as a result of that. In terms of margins, so again, our core profit margin remains intact. Our profit numbers are actually at all-time high. What you see in terms of the slight depression in the EBITDA margin, that's merely an accounting entry. Because, as I said, the international raw material prices were volatile, as a result of which, as a conservative policy, we have taken a markdown on one of our raw material inventory. And that has pushed up the cost of goods sold, causing the slight dip in profits. But as we go forward, as those raw materials get converted into finished goods, we will see those accounting entries being written off and the profits come back to normal levels.
Mr. Rastogi, could you give us an end of the year number for both? Where would order book be at?
So,
and where would margins be at?
So, what I would say is that the Indian solar market is growing exceptionally well. We had a best ever quarter, Q1 FY26, in terms of capacity addition, 11 gigawatts, which is more than double of what we did last year.
Mr. Rastogi, numbers would help, sir. It just focuses the mind.
Yeah, so, unfortunately, I can't give you any guidance in terms of numbers for us as a company policy, but we have a very healthy order book. As well as a discussion pipeline with the customers for future orders.
Have we seen the let me put it another way, at 30% EBITDA margins, is that a bit of a ceiling? And we kind of, same time last year, the EBITDA margin was 16%. 16 is now 30.
Correct.
Right? So what should we expect? Direction of travel?
So I think the direction of travel, as far as we can see, is pretty encouraging and near the current levels. We have an order book already signed in place for next year's production, which is nearly at the current margin. So I think we expect the visibility at these current levels to stay for some time.
Okay, all right. Hi, Mr. Rastogi. Good to see you, Ben. The cell capacity has been coming on stream. I think in this month, there was another capacity that came on stream for cells. Or it's due to be coming on in the coming months. Tell us, out of the total cell production, how much of it is consumed in-house and how much of it is sold to third parties?
Yeah, sure. So you're right. Our new cell line has come online. It is one of the most advanced cell lines in India right now. We consume part of the cells in-house and partly sell outside to other manufacturers. And that ratio, it tends to vary from quarter to quarter. But very broadly speaking, we try to maintain the ratio at about 50-50 levels.
Okay, all right. So 50-50 levels. And as you get backward integrated, then will that be an additional reason for margins to go up from here on? As Prashant just said, you were doing teens, you're gone to 30%. But as backward integration comes about, is there scope for further margin improvement, or you'll be satisfied at around this 30% ballpark?
So, I would say two things. One, we are integrating backwards. So a lot of the raw material that goes into solar module production, we will start making ourselves. So that will definitely help the margins go up. But the second equally important factor is that, we are moving the policy framework, moving towards more and more value addition in this space, which means customers are mandated to buy in India, and the share of Indian manufacturers as a result in the whole market is also expected to rise. So overall, because of these two factors, like I said, our margins should be very stable, and if anything, positive because of the backward integration.
Okay, all right. I just want to take that point forward itself because you've mentioned in your con call as well, you want to focus on India. Exports has come down to 1%, and that's not a focus area. Previous quarter, I remember it was around 6%. Now, if you're saying that, Indian producers, Indian manufacturers will gain a greater chunk of the market share, what is it currently? If you could give us a rough number, and what is the opportunity then?
So, this year we expect the Indian market at about 40 gigawatts, out of which imports will account for about 15 gigawatts, and the rest would be the Indian manufacturers. So we are talking about 25 gigawatts out of 40, which is a market share of about 60%. In 2 years' time, this 40 gigawatt market size is expected to go up to about 55 gigawatts, with the entire share coming from India. So, which means the share of Indian manufacturing is going to actually, or the absolute volume is going to double in size over the next 2 years.
Vinay, finally, just very quickly, apparently cell prices in China have picked up in the last 2-3 quarters. Some reports suggest they're up 30%.
Correct.
Can you just tell us if that has any second order effect here on pricing in India? What is generally happening with cell pricing here, modules, and just how you see the next couple of months shape up on this?
Yeah, sure. So, what is happening in China very quickly is that the Chinese companies have been selling below cost. They've been dumping their products because they have so much oversupply and overcapacity, which was not sustainable. So I think they've had a lot of pressure and the prices have started going up finally. The good news for us is that the Indian market is pretty insulated from what is happening in China, partly because of the government of India policies, and also because of all the investments that we have made in our own capacities. So I think we don't see there is temporary some minor adjustments that we have to make in terms of our purchases, timing of our orders, etc. But by and large, our pricing and the profitability remains intact and insulated from any movements in China.
But can you demand higher pricing for what you're selling outside, not the captive use, but outside? Do you see higher sell prices in India?
So yes, I mean currently the sell prices in India are higher, but that is again depends on what you're comparing it with. If you're comparing it with China, I would say that is not a true benchmark because the Chinese companies are selling below cost.
Yeah, absolutely. It's interesting, and maybe next time we'll press upon that. You said EBITDA margins should be, we should be able to hold on to it for some time. So that for some time is the question. Thank you very much, Mr. Rastogi. Appreciate you joining us, and good speaking with you here on CNBC TV 18. Good luck. We take a quick commercial break here. Manisha Gupta joining us on commodities. What's top of her mind coming up in just a bit.
Welcome back. Well, we've got Mitesh joining in. Mitesh, good to get you back. So what are the trades now? Recovery from the lows?
That's right. And, as I said, we might not drop much below 24,500. We actually got a low of 24,598. So I think this is the area where, medium term and weekly supports start kicking in. And the put call ratio was also getting close to kind of oversold levels from where we have seen some kind of bounce back. So I think maybe in the short term, you will not see much of a traction on the downside unless until we start breaking below 24,500, 400 zones. Having said that, I have a buy on Alchem Labs. That's a stock which is making a fresh swing high. So keep a stock below levels of around 50-50, maybe 50-40. On the upside, look at targets of 51-30 or thereabouts. And the other stock which I like, that's Cipla. I think Sudarshan had given that call as well in the morning. After a good rally, the stock has been consolidating for last few hours, but looks like there will be a continuation. So 1548 is the stop was recommended and 1625 is the target.
Okay. All right. Got it. Mitesh, thank you very much for that. Let's quickly shift the focus to the commodity markets. We have Manisha joining in with the latest. Manisha, good morning.
Morning, and thank you for that, Surbi. I'm talking about the crude oil prices because we've seen strong gains overnight come in for this one. The first part of the week wasn't so strong, but we've seen 2% of gains overnight, and with that, we are trading at a one-week highs for the crude oil prices. The latest trigger clearly comes in from US, which has shortened the ceasefire deadline for Russia now. The US President Trump released a statement yesterday saying that Russia has 10 to 12 days now to agree on a ceasefire or face further secondary sanctions as well. Remember, it wasn't too far back that European Union also released an 18th package of sanctions on Russia, and this time around it has been on oil and energy. We have seen sanctions come in on in sense of price cap. There also are individuals and institutions which also are now facing restrictions, and apart from that, apart from the cut in the price cap as well, total 400 ships, shadow and direct, have been sanctioned now. So this really does impact the flow there. And we also have a JP Morgan report in the meanwhile suggesting that the further US sanctions, if implemented on Russia, could lead to a supply shock as the OPEC Plus does not have that kind of a spare capacity, and that led to premium in case of prices there. Well, the support also comes in from the fact that we're looking at various tariff records now coming in. US has seen tariff agreement with Japan, UK, Vietnam, Indonesia, Philippines, and that seems to be supporting the risk sentiment and the belief that you could be looking at demand growing going further. Of course, there are deals on table as well. You still have China, the conversations for that started on Monday, and then you have Mexico, Canada, India, these deals still on the table there. The support also comes in after the OPEC report, which says that they are looking to pause further production increase from the month of October. Remember, OPEC has been increasing production from the month of April, and they are doing it until the month of September. October could be a pause, and that clearly is supportive for prices. There also is a statement from IEA which says that the global inventories have been increasing and accumulating at a rate of 1 million barrels per day, which is 1.5% of total global consumption. Markets looking at this number as well. And then finally, it is about the US crude inventories, which we have seen continue to decline quite sharply. The US crude inventories right now are at a 4-year lows, and they are 18% below the seasonal 5-year average as well. Not just the US crude inventories, the distillate inventories are also more than 18% below seasonal 5-year average, some of the factors which clearly seem to be in support for crude prices.
All right, Manisha, thank you very much for that. So oil in focus. We'll take a quick commercial break here. We get chatting with the management of Bank of Baroda on the back of their first quarter performance. Lata will take you through that conversation with Mr. Devdatta Chand coming up in just a bit.
Welcome back to our earnings corner. Bank of Baroda's first quarter results were a mixed bag. Very resilient net interest margins, but higher slippages due to an overseas loan and a slight uptick in personal loan NPAs. But the net interest margin was the cynosure of everyone's eyes. It fell by only 7 basis points. Remember, for many private banks, the margin has fallen by between 15 and 25 basis points. But can the margins see lower levels now in the current Q2 and in Q3 because of the rate cuts? Also, can loan growth maintain this 12 to 13% run rate that we saw in Q1? For all these questions, I'm joined by Mr. Devdatta Chand, Managing Director and CEO of Bank of Baroda. Good morning, Mr. Chand. Thank you very much for your time. Well, first up, it is the margins question. You all controlled it well in the quarter gone by, but will it take a bigger chunk in the current and next quarter? Have you any estimates?
Thanks, Sweta. Good morning. And as far as the margin is concerned, it is typically because of the rate transition that is happening on the economy. And as you said, right, that the book has shown a resilient in terms of the margin cut as far as Bank of Baroda is concerned. So going forward, what we see that major part of the repricing, the full quarter impact we are going to see in the next quarter, that is Q2. And this quarter, the full impact has not come. So there can be pressure. At the same time, on the deposit side, we are seeing significant repricing. That means the interest expenses is going to go down for the next quarter. So net to net, there would be impact, but we are not looking at a significant impact on the net interest margin in next quarter. That's why the full year guidance we are giving at 2.85 to 3, with a quite bit of hope that Q3 and Q4 will be much better than the Q1 and Q2.
Okay, so you're expecting the recovery in Q3 itself. Q2, you think, will be at the bottom?
Yeah, that's right. Q2 would be the major impact Q2 would take, but Q3 and Q4 would be much, much better.
Okay. Well, the other point is, of course, on slippages. There is, of course, as you pointed out in the investor presentation as well, that there is one international account, but there was a bit of pain in the personal loan account. Can you take us through the slippages picture and how it has evolved? Now, you're already 2 months down in the second quarter. Can you give us an idea of how slippages might pan out sector-wise?
Yeah, as far as the slippage is concerned, even if with the international account, we are well within our guidance range of 1 to 1.25. And because this international slippage is one-off, so excluding that, the slippage ratio would be at 0.99, which is comparable with the slippages we have seen in the earlier quarter. Our normal run rate on slippage per quarter is roughly around 2,800 to 900. So in that, the bank is well within the slippage guidance, and excluding this one is all comparable with the earlier quarters. Saying so, on the personal loan, on the legacy book, we have seen some 100 of crores slippage, but in terms of slippage ratio, because the denominator is also increasing, the slippage ratio is well within the comparable parameters with the earlier quarters. So we are not seeing any elevated level of slippage going forward. On the collection efficiency is much better now. The credit book looks very, in terms of the SMA 1 and 2 looks much better now. So we are not thinking of the asset quality of the bank is quite robust and resilient enough to take care of any impact because of the slippage going forward.
No, I'm not saying that you will be in trouble at all, sir. After all, you'll have historically low NPAs of 0.6%. There's no question of any problem. But what I'm asking is that, is there any vertical, for instance, unsecured personal loans or MSMEs, or any, international book where you may see pain? Have you already noticed in the first 50 days of the current quarter?
Yeah, as far as international book is concerned, again, the asset quality is quite good. And this particular account is a one-off clearly. So other than this, there is absolutely no other account which has any sickness as on today. Secondly, on the domestic book, only on the retail advances, we have seen some 150 crore of additional slippage as compared to the last quarter. And precisely, as I said, that because of legacy personal loan book, the slippage has been there. But as a strategy, earlier the personal loan used to grow at much higher pace of 30, 40, 50%. We have moderated to 20% this quarter. And I don't think, this additional slippage is because of the legacy book. On the current book, absolutely no stress therein. So, but in case you compare the slippage ratio, then it is well within our earlier quarter slippage on the personal loan.
Okay. Just one number came to my eye when you have a page in your investor presentation, which says that the MSME loan NPA was the highest. It was 10,600 crore. In everything else, it is, the next big is agriculture, which is 7,000. Then is retail, 5,000. MSME 10,600 is standing out. Is that likely to give you any trouble at all?
No, not. See, MSME, there are a percentage of this outstanding is again because of different government scheme, the government guaranteed they are in the credit guarantee coverages they are in those NPA outstanding.
Oh.
So, but at the same time, if you look at the slippage ratio for MSME, because the MSME growth last year was 14%, and this quarter it is almost at 12.4%.
Yeah.
Considering that the denominator is also increasing. So, what is important here to take note of is a slippage ratio. In terms of ratio, we are not exceeding our earlier slippage ratio in MSME.
Okay. Yeah, there is a 13% rise in MSMEs and 17% in retail. Yes, but 13% is a fairly robust number. Let me come to credit offtake. Credit growth on the overall number looks very good, even if it is a Q fall. That is to be expected. After all, the March quarter tends to be very strong. And with the start of the monsoons, Q1 does not match up to Q4. But can you repeat a 12% growth?
On the overall advance, absolutely. Our guidance is 11 to 13%, and this quarter also we're at 12.6% on the advance growth. So only the RAM segment, which is retail, agri, and MSME, almost growing on an organic book 18%. So that's significant. At the same time, the corporate, typically the first quarter of the year, we do a bit of realignment. What I mean by saying that, because we have reduced the bulk deposit to the extent of 23,000 crore. So obviously the fine price asset typically because there is a repricing happening, so we could not do those transactions. So the corporate growth is 4.2%. If you compare the corporate growth of 4.2% vis-a-vis the last year, the same quarter, that was at 2.5%. On a full year basis, we could achieve around 9 to 10%. And we are hopeful also this year that on the corporate also we are going to have something around 9 to 10% for the full year. Saying so, the RAM continued to be the growth driver. And this time the RAM growth is almost 18%. But I expect at least a 15% growth for the full year on the RAM side also. So RAM growth of 15%, corporate growth of 10% typically would put us into around 13% growth on the advances side.
Okay. I hope you know that you are on the higher level in terms of guidance. Practically no one is guiding 13%. On the street, certainly not the private sector banks. They are closer to 10. What's the likelihood of the ROE going down in the current quarter? You all are very close to 1%, and there are a few people out there who worry that it may go down below 1 because the NIMs will be under pressure. You think so?
So look, the ROA has been in excess of 1 for last 12 quarters now.
Okay.
So a scenario that where the bank is actually the book is quite resilient in terms of both profitability and also growth on the top line. So the full year guidance again we are giving that the ROA has to be more than 1. The quarters where the NII is slightly bit a challenge because of the interest rate transition, we're able to optimize on the other income or the non-interest income.
Okay.
So going forward, I think we'll be in a position to maintain our guidance of above 1 ROA for going forward. Okay. As you talked about the ROE, as the bank is generating enough profitability, so ROE is almost at 16%. So going forward, again, when you grow, because I believe there is enough opportunity in the market for us to grow, then the ROE also is going to have it is currently very strong and going to be strong. I'll just give you a few of the bank's book. Look, one of the key piece of the bank's entire book is the way the liability management has been. At a cost of deposit of 5.05, at a CASA percentage of 39.33, at a domestic NIM of 3.06, I think the bank book is well positioned to capture all the opportunity that the market offers. At the same time, also, in case any headwinds because of the geopolitical scenario, also the bank book is quite capable of handling it.
Okay, fair enough. I'm not doubting that. And even if there is a dip, it is expected only for 1 quarter, not for the full year. The other issue I wanted to know is that, in your various meetings that public sector banks have with the government, is there any move to remove that 20% cap that FPIs have? it is not serving any purpose. They will buy what they will buy, irrespective of whether they are allowed 20%. Because of that, IIFL has made a calculation that SBI is losing some 1.4 billion of passive inflows. You are losing some $200 million dollars of passive inflows. Is there any discussion at all that this cap, that sentence is just dropped?
Look, as far as Indian banks are concerned, going forward, let's say we talk about next 5 years or 10 years, banks would require capital. So, I mean, that's something we require it. But with the FDI cap, it's a policy issue which the stakeholder would take a call. Obviously, the data you are presenting is known in that way. The stakeholder would take a call with regard to that. But as far as banks are concerned, definitely going forward, although our CRAR is quite comfortable as on today, and that can take care of our requirement for going forward. At the same time, on a 5 years or 10 years horizon, possibly bank would require capital and possibly the call would be taken at the right time.
Yeah, fair enough. One hopes. I know this is a question to the finance minister and not to you, but I was only wondering if it comes up in your discussions. Just a final question. Are you all tapping the capital market in any way? I mean, either sale of your stakes in any of the subsidiaries or even holdings like NSE, or even raising capital for your own sake. Look, your competitor, State Bank, has raised 25,000 crores. The market is kind to banks who have done well. Any way will you approach, either for your subsidiaries or for yourself, either for selling or for raising?
So there are two aspects here. One aspect is your own capital raise. So we had announced to the market earlier that on a medium term, we intend to raise roughly around 8,500 crore of equity that we already announced, but at a time where it would be required for us to raise. So immediately there is no plan as on today. At the same time, on the monetization of the assets, subsidiary asset, already there is a plan. But again, I mean, all this monetization depend upon the right valuation, which is again one of the important factors for us to consider. So a couple of our assets like subsidiary, the divestment or the IPOs are in the pipeline. We are discussing also how do we again come out on that. So that would continue like the moment we get an opportunity time, we'll keen to monetize that. But as far as bank's own capital is concerned, as on today, we are well capitalized. At the same time, yes, there is a plan to raise capital in a medium term, not immediately. But you are right that the market is kind. I mean, at the time, we'll take a note of that and then decide on the matter.
Yes, the market is certainly kind. Your stock is in the green, though Bank Nifty in general is not doing too well this morning. Thank you very much, Mr. Chand, for joining us with your thoughts. We leave the market in kind of cautious optimism, if you please, though at the moment I should say cautious pessimism. Stocks across the board, the indexes are in the red. Mid-cap is about a little better than the rest. Let's see if after the first hour of caution, the market perks up. Wrap up on Bazaar Chartbusters coming up.
IndusInd Bank up and about despite a muted show in the first quarter on the profit front. Over 120 basis point spike in margin surprises straight. The management guides for single-digit operating expenses in the quarters to come, though the stock, after an up move, has now moved lower by about 0.25%.
Piramal Pharma is off the opening lows. A muted show in the CDMO segment, coupled with a net loss of around 81 crores in the June quarter, weighs on the stock.
A weak show from Mazagon Dock across parameters in the first quarter. Lofty expenses in the quarter gone dent profitability, while margins taken near 1,500 basis points hit. The stock lower by 4%.
Paradeep Phosphate jumps nearly around 8% after the company reported a multi-fold profit increase on 255 crore rupees from around 5 crores year on year. The revenue also sees a 57% increase, while margins expand significantly.
Shares of Go Digit jump over 5